What is going on, guys? Welcome to today's episode of the Collecting Keys Real Estate Investing Podcast. This is the show where we teach you to make massive income, not just passive income with your real estate investing business. If this is your first time here, this is Wednesday, the Mike and Dan show. And I am Mike DeHaan here with my co-host, Dan Austin. And on these shows, we teach you, we talk about real estate investing, business, and whatever else we feel like this week, kind of depending on what's going on. And we are doing something a little bit different for these Wednesday shows for, I don't know, maybe today, maybe a little bit longer. We'll find out. But we have a third member to the show today. So this might be the, MDD show here going into the future. But we have a longtime Scale community member, Dylan Koch, who is joining in on these Wednesday shows to kind of help us have a little bit more grasp, or contact with reality of what most real estate investors are going through in this current market. Because, I hate to say it, but also not really. Dan and I, we have grown our business a lot, and we tend to look at things these days from kind of like a pedestal. We're a little bit more removed. And Dylan, you have been responsible. You've been in the Scale community for about 2 years, and you are still a solo operator. And so we thought it would be awesome to bring it in and, bring some news, some, some flavor, I guess, that is a little bit more applicable to a lot of people. So, yeah. So Dylan, maybe give the audience a quick 30-second intro of who you are, what you do, and what your business looks like.
Yeah. So thanks for having me, guys. I think this will be fun. And my goal is to make it to episode 2, I guess, of the MDD show. But anyway, so I'm based out of Cincinnati, Ohio. I was a former pharmacist, left that in October of 2021. And since then, we've done over, I think it's 150 off-market transactions. It's about 1.5 million in total revenue over those couple of years. And that's not including any of the buy and hold stuff. We've got about 4 million in real estate on the buy and hold side. So, and I am just looking to grow that, also scaling up. But like you said, I'm in the business every day, making the phone calls still with the sellers. So maybe get some opinions around the nitty gritty side of the business.
Yeah, absolutely. As your business has grown, you've gone the path that every real estate investor goes, where you become another white guy in your 30s who decides you want to talk about real estate on the internet. So you'll fit right in. And if Dylan sounds familiar, exactly. And if Dylan sounds familiar to you guys, because he was on episode 207 a couple months ago and had a really, really popular episode back there. So I guess how we will do this week, Dylan, you have kind of done a little bit of research for us, dove into the real estate industry, kind of like news and different things, and discovered some good talking points. And so I guess for everyone's context as well, Dylan's a very well-read person, very educated, very sort of in tune with the economy as a whole, whereas Dan and I are a couple of knuckleheads. So you bring a ton of additional viewpoints and things. And
you're smart too, which is incredible.
You're smart.
Smarter than us.
The joke, one of the jokes you made when we were setting this up was, what'd you say? You said you've seen some real dumbasses make good money simply because they worked instead of procrastinated. And I was like, yeah, this is honestly me. So
you've described me, and I'm not offended.
But awesome, man. So what have you found for us today, or what are some of the big things going on in the real estate space?
Yeah. So the biggest thing that I found recently that I think is going to fly underneath the radar is there was an article put out by a couple of news outlets, but it came up in Time first, or like a financial magazine. And it was basically about a Freddie Mac getting into the HELOC business, or like the home equity line of credit. Right. So to give a little bit of context, when a loan is set, they usually, these services are just checking boxes that are set from Basel III post 2008, and they mix them all together and they sell them off. So the government is basically on their books as mortgage-backed securities. Right. Mm-hmm. Well, nowadays, since post 2008, 85% of mortgage transactions take place, or like originated and go through this process, that are either Freddie or Freddie, FHA, or VA. So any of the 4 government agencies. Mm-hmm. And so now they propose this, and I think of somewhat of a timely manner, where they expect $1 to $2 trillion being extracted from equity in really later boomer type people's homes, because that's where most of the equity sits. Mm-hmm. Right. Yep. So I can do a little bit more talking points, but what are your guys' first initial reactions to that?
Well, it's kind of so are these like HELOCs or are these like home equity loans?
No, they're like HELOCs. Like, and so they would be in second position, and the guidelines they have around it now is they're 80% total of the LTV. So, right, if you had $1 million home, you have 500,000 on it, you could take up $300,000 as a line of credit.
So 80% of the actual equity.
Right.
Yeah. It seems weird for me for the government to want to get into HELOCs because, I mean, the whole thing with the Fannie Freddie loans is it's a sort of fixed, amount of income and interest to be coming to the federal government through these payments. But with the HELOC, you basically just have these big lines of credit. I mean, if it's going to be trillions of dollars worth of lines of credit.
My question on that is, I guess why you're pulling on the thread, Mike, is with this do they call it like a closed end loan? Meaning, is that a government term, like a closed end loan? Does that mean like they're like it's a 20-year loan or a 20-year term? What does that mean? I don't know.
They when they put this out as a 60-day, what they call it, like a writing period or like a feedback period, and we haven't even gotten through that yet. It's so new. But from what I understand so far, this is going to be like a traditional like line of credit that you could pull in your house, but basically secured by the federal government. And then they'll use like the rocket mortgages or other services to help service the loans, right? But
so then I guess how does it work? So basically they're using rocket mortgage or whatever to, service the loans. If the person draws it, do they just like sell it to the government like immediately? What happens if it's a kind of janky?
It's already on the government's books. It's like it already, just like your mortgage today would just already be back on the government's books. They the same servicer.
Yeah, they back it, and then they basically just sit there like on their balance sheet on the would it be the Federal Reserve's balance sheet or something like that, right?
Right.
As a security that's backed by second position in a property.
The author of this podcast too, that really got my attention to it, was they think that if the economy is going in a downward trajectory, we have an election in November, and this is supposed to start taking place in September of this year, then they basically want to use this equity as a cheap way of financing. So those already affluent people will tap into 2, 3, 4% debt again and use that for consumption, right? And kind of drive up those GDP numbers. Is there
donate it to the Trump campaign? That's what we're going to do.
Whatever campaign that you want.
All those boomers are going to tap the equity, dude. You got to get them out of prison. Here's I guess some like unfiltered thoughts I have on this. It would be a great time to be a loan officer to originate these. It reminds me of like the refinance boom where loan officers are making $800,000 a year just doing freaking, cycling through loans, cycling through the refinances. I would assume that there would be some similar incentives to underwrite these HELOCs. I think it's a terrible idea. Like, not good to just, and what they're seeing is you made the comment, Dylan, of like basically cheap debt or easy debt to add, because they're like, where the hell else are we going to grab debt? We can't just, we already know we'll get our asses handed to us if we decide to print more money, especially going into an election year. And it's another hidden way to provide this and get the economy stimulated, and then be like, well, we don't know where inflation came from. So it's a terrible idea from that standpoint. I don't think it's great. But what I'm seeing is we've found that home ownership is the quickest way to wealth. And then like during the COVID period, like this last several years of inflation, the reason why everybody has so much equity in their home is because their equities, like their homes are their like largest assets, right? And those grew and in some markets they grew like way faster than inflation because that's where people were migrating to. So I think that this is just squeezing more juice out of the home equity orange, to use that euphemism, and it's going to just put people in a way worse situation. And the problem is then all the millennials and Gen Zs are going to be pissed because they're already mad that their mom and dad are rich and not giving them money. Wait till mom and dad tap the equity in their lake home and spend it on a car, and now they're like, darn it, we don't have our lake house anymore.
Yeah, I mean, I think it's going to keep prices high. Obviously, right? Because one of the biggest reasons people sell properties right now is because they look at it and they're like, we have $700,000 worth of equity. We don't want to get a longer term fixed payment that's higher. But if now they can just tap like parts of that super easily to be able to, go on vacation or buy the boat or do whatever during especially their retirement, like no one's going to sell anything anymore, especially if they're easy to get. I guess what's the advantage, or like what are the term differences going to be with getting one of these like government backed ones versus one that's like from your local bank or credit union? Did they outline that?
Good question. The author of the podcast, and we can link it at the end too, basically said that they're treated differently. Where if it's basically sponsored by the government, there's a reason FHA buyers have a lower interest rate than someone who's conventional, right? It's going to be the same thing. If it's backed by the government, then they might be able to get a HELOC at 4%, where if they just went to their local lender, they'll have to get it at 5 or 6%.
Yep.
So they're like cheaper HELOCs.
Yeah, it'll be not only backed by the real estate, but it'll be cheaper just because the government's going to back it, and like there's no really risk of loss, quote unquote.
Yeah, and I'd be curious to know too if that has something to do with income requirements that a bank might, that if you're going to put like 80% of your equity on a I guess recurring line of credit like that, maybe for the baby boomers and people that are retired that maybe don't have great income source, but a lot of their wealth is locked up in their house, right? Then they can use that, and because it's backed by the government, maybe the underwriting will be less than, maybe like, oh, you're on Social Security and you have a little bit of pension money coming in. We're okay with you getting an $800,000 loan at 4 or 5%, when you use it interest only type thing.
Right. And I think the bigger aspect that you both kind of alluded to is, one, yes, it'll probably keep prices higher. And it kind of even widens those alligator jaws of people who are just starting, like millennials or even Gen Zs, right, who are trying to afford these homes. Whereas the people who already have the assets for 40 years and 40 years of declining interest rates, right, that it's just going to widen the wealth inequality, I think, because like you said, most people, most of their net worth is in their house.
Yeah. And I would think too, is maybe it's like there's some forecasting of these people like us all who probably have very low interest rate mortgages. And we do not, a lot of people don't want to move or sell their house because they're mentally locked into a 2.5% interest rate. And they also bought pretty high compared to a high interest rate environment, right? Like we haven't seen prices decline that much, but they have softened in some markets. So if you think about it from the macroeconomic standpoint, it's like one of the number one drivers in our economy is real estate and construction related to real estate. And nobody wants to trade off of their loan. And these banks that are servicing these loans probably would love to get them converted to 5 or 6%. I think doing this is would force that people out of that kind of like groove where they're not going to do shit with their house because they don't want to give up their interest rate. They don't want to sell their house, right? So it's like they're maybe foreseeing an issue with these low interest rate 30-year mortgages already.
Yeah. Are these only for primary residences? Can you use it for like
rental properties? So. I don't know, but I would assume that they're only for primary residences.
Because if they start doing this for rental properties too, stuff's going to get real weird real fast.
Oh, God. All these Airbnb guys, like, I'm just going to max this out.
Well,
got to pay for my cleaners.
Even looking at our stuff, Dan, with all the equity that we have in our properties, I mean, imagine if we could just go get like $1 million line of credit at like 6%.
Right. And can you reinvest that at higher than 6%? Probably.
Of course. Yeah.
Oh, yeah, dude.
Well, do you think that it'll start to affect those sort of things though as well? Like, what is this going to do to some of these like cash accounts or like T-bills? Like, are these even connected at all?
I don't think so. But it would, if you're an investor, an everyday person, you would look at your opportunity cost, right? Okay, you go buy a T-bill at 5% guaranteed rate, or you could take out $1 million at 6% and try to reinvest that.
Yeah,
totally. Yeah. Huh. Yeah. I mean, it is interesting. I do, I guess, get concerned with the government suddenly giving people access to $2 trillion in a way that can be treated like a long-term credit card.
Right.
Because
what would people do with it?
All sorts of dumb shit, dude. My fucking neighbors across the street bought like a boat and like another
That's
house
what I
and
mean,
got
right?
divorced, and it was a whole fucking disaster.
Yeah, and they moved in they did all that within a year.
They did, seriously. Well, they bought their house in 2020 for like $585,000, right? They said they sold it for $1 million after they got divorced, like, I don't know, less than 4 years later. But in that period of time, like, they refinanced it, they got the HELOC, they did all these things, and they were all of a sudden buying the $150,000 boat. They bought a lake place and all these things. And then like it went from them like living high on life. They got divorced. The dude was asking me if we had any rental properties in like Hilliard, in like the worst neighborhood that he could move into. Yeah. Right. And he's like, yeah, my budget's like $1,400. I'm like, dude, you're going to be living in a cardboard box here.
Yeah. These are the same guys that always tell you divorce is expensive. They're like, yeah, dude, it's expensive when you do dumb shit all the way up to your divorce.
I know. But they were leveraged to the hill, and a lot of it was because they got this big HELOC and all the other things. And because I know they did that because that's what I told them we did.
You're like, you should totally do it.
Yeah.
Minus the boat part, right? You didn't.
Yeah. Yeah.
Well, I think to the furthest point is like, how much of the government do you want to be directly correlated to housing? Right? If they're already 85% of the primary residence market or like origination market, like original loans, and now you're adding HELOCs on top of that. I mean, not that they're ever going to go away because that would literally like cripple the economy, but like, I don't know. Like my personal opinion with that is I would like more competition for that kind of space.
Well, how far are we away from I guess the government owning housing? Are we far away or are we not far? Because I mean, think about like hedge funds. We've known that they were leaning hard into single family rentals, right? They've been doing that for the last few years. Like, I mean, the iBuyers have been around for a while, but like legit, like JP Morgan Chase and like companies like Tesla are like taking money off their balance sheet to put it in residential real estate. So what's the difference between the government basically taking over all of your housing because nobody can pay for it anymore in a hedge fund investing, right? Because it's like all the same money, and maybe they use the hedge fund essentially as like an extension because they buy up all these cheap ass mortgage-backed securities.
Yeah.
I don't know.
Good. I mean, other countries have that where the government kind of owns all the housing. Yeah. I mean, not always good countries.
I mean, that would be.
Is that a good or a bad thing? Though?
So that would be communist in a way or socialist in a way. But I could see the government utilizing one of these big banks, these big hedge funds, as an extension of basically doing that, though. Because what's the difference between, JP Morgan Chase owning your house and the government? Not a whole lot.
Yeah.
Yeah. I mean, and I think I'd encourage everyone to, I mean, this podcast that I listen to is like 90 minutes and it goes into some of that stuff that's really in depth.
What's the name of the podcast? It's
The Thoughtful Money, and it's written by Adam Taggart, and I'll link you to the episode, like number or whatever it is. Because I think it was like a week or 2 weeks ago that it released.
Okay.
Yeah. So like a really quick Google search, I found a Reddit group. I mean, if you if anyone's a Redditor, you never. I mean, the easiest way to realize how little people on Reddit know is to find a subreddit that you actually know about the topic.
Yeah.
So take this for a grain of salt. But I did find a little post talking about the wealthy countries that have solved affordable housing, and a lot of it's around subsidized housing, kind of like we're talking about. And people list mostly Asian countries, Japan being one of them, Singapore.
The difference with Asian countries and like Anglo countries like us is like
they're all the fucking same people, dude.
Well, they take care of each other, and they have like like where they take care of their families and stuff like that. So like their culture is to like, hey, we all have to live here. Let's like make sure we do it okay. In like our country, they're like, eh.
Well, they're also the opposite of a melting pot. Like they are literally all the same people.
They're all the same, yeah.
Like people go to Japan and they're like, why are they so polite here? It's because they were raised exactly the same.
Right.
They don't have 18 different cultures in like a city of.
Yeah, people aren't flying to Japan to move there, right?
Yeah.
They're not.
Very, very rarely. They make it hard to do that.
I think a good topic for next week, I'll actually dive into that, is like how many hedge funds actually buy houses? Because I think it's over exaggerated for a lot of people think.
Yeah.
So we'll put some data behind that and maybe talk about the follow-up.
Let's talk about it, yeah.
Yeah, that'd be interesting. Well, this whole discussion though, too, it's actually making me think as well. I know you had a second topic that you wanted to bring up.
Right.
Around
and so
the one,
good segue.
Good segue to, go ahead and introduce it.
Yeah. So at the end of that same article, it said right now, 11% of FHA loans are delinquent, which was actually higher than like 2006, 2007, 2008. And that's currently. But so that just shows kind of, I think, that wealth inequality we touched on earlier. The upper people are doing just fine, right?
Mm-hmm.
But the lower people are like just coming in the workforce or don't make a whole lot of money for the area are really struggling. And I've even seen that, and anecdotally in my own market, deals that come in that I think are going to be great deals, but the payoff is too high, right?
Mm-hmm.
To make
how much of that do you think was artificially caused by this COVID event when people were doing forbearances? And now they're in delinquency because they're probably, maybe they had to do, because they had a job where they were working in person. They couldn't work from home. So they were out of work for, a few months or something like that, or a year, who knows. But say they went into forbearance for 6 months, but they're paying now, but they have not paid their forbearance. So they're technically, would that consider them in default or something in that nature that would inflate that, or at least have caused this delinquency because they missed 6 months and now they can't pay for their forbearance fees?
I think the forbearance thing is just like they just threw the payments on the back end of the loan. They basically just extended the loan, right? So I don't think they're actually paying any more now than they would have been.
Okay, so that would only affect them at payoff.
Right. So they might owe more than they think they do, but I don't think their monthly payment is changing all that much. I just think it got so overblown that, and like people were pushing those, especially FHA. Like I think the underlying standards need to be a little bit more robust because you could, buy too much house too easily.
Dude, I mean, that was the story of 2021. Everyone was selling overpriced homes to these FHA dipshits.
Shithole houses. Dude. Mike and I did the same thing, and shithole houses, and their agents coming in with a $30,000 to $40,000 over ask because nobody wanted an FHA buyer, right? So they had to. So the FHA buyers again got screwed by the environment and the economy around them, and their quote agent, who is a new agent because they're dealing with FHA buyers who are typically younger or lower income. So it's an agent with 3 months of experience. So they're like, I heard on the internet, on Reddit, if you put a $30,000 offer over asking, you'll probably get accepted, which is not actually wrong.
Yeah, it's not wrong.
Well, I mean, remember that one, Dan, where we literally had to pay off the guy's credit card? It was like $27.
See, that's insane. Yeah, is that really going to make a difference? Like,
it did to FHA.
Yeah. But so the article that in question here is from Axios. It was posted on May 13th, and the title is "Over 1 in 3 U.S. homes are bought with cash." And it's kind of a clickbaity title, in my opinion, because this is not necessarily hedge funds that are coming in or real estate investors like us that are coming in. This could be grandma, grandpa, or the parents to someone who are just buying their kid a home that are already well off, right?
Sure.
So there's some nuances around that, but what do you guys think as far as the 1 in 3 homes being bought with cash nowadays?
Well, it's going to become more than that here pretty quickly if people can suddenly get HELOCs super easily because people are just going to tap into their existing home and buy their millennial kids who have been complaining about not being able to buy a home with the equity in their family home, right? And it's technically still tied to debt, but it's much easier to get than a bank loan, right? And it's basically their way of the family being able to give that family equity to their kids to buy another asset. I mean, that's honestly kind of scary too, because what'll start to happen is you're basically buying these homes with like rotating debt if they're using HELOCs. Because let's say they started out at like 5% on the HELOC, and then all of a sudden it increases to 11% for some reason or another. And now you have the parents are like, hey, you need to like go pay that off now.
Yeah, right.
This is a lot.
Yeah, right.
I mean, I'm looking at this graph and it doesn't honestly scare me much because I'm looking at 2013 and it was higher. It was like 37%, maybe 36%. Yeah.
That's because homes were cheap back then, though.
Right. And well, in 2012 through 2014, it was about the same, maybe a little bit lower. If we macro like scanned out to like 1980s, I'd be curious to know what that number was percentage wise. If it follows the trends of interest rates too, like higher interest rates, people deploy cash more than not. I have no idea. But it doesn't scare me just because of the trend, because it looks like it's following a cycle that actually follows interest rates.
I'd be curious to see how much of this is tied to like migration, right? So people that have their home that they sold in Santa Barbara for $2.5 million that they bought for $400,000 25 years ago, right? And so they're walking with a couple $1 million and they're moving to like Boise. And they're buying like a sick home for $1 million cash.
Well, we definitely saw that, like, you would have seen that a lot. You would have seen like, say 21, 22, but the numbers have slowly climbed since then. So maybe people are still migrating outside of that, out of those areas.
I think you're still seeing that. I'd see if anything now you're probably seeing that more because you can still sell your houses for a pretty penny, but you're less incentivized to get debt. Back then, people that were wise to that, they would have been happy to get a mortgage. They're getting them at 2.5%, 3%. Yeah. Now they're getting them at 7%. So I could see the play with a lot of these people being they sell their Santa Barbara house for $2 million. They move to wherever they want in, Rifle, Colorado, whatever the hell, buy their house, and they're going to just refinance it when rates come back down again.
No, I think that's a good point. I think that if you overlaid this with cash purchases in the Sun Belt right now, Orlando, Florida, like some of these hot destination markets, it's going to be a lot higher than areas that are the more affluent areas part of town.
Yeah, that's a great point. Yeah, if you looked at like it could be market, like we're looking at averages, but you could go to some of these other markets. I bet to your point, Dylan, I bet you Sunbelt states are always higher on average than like where we all live up in like the shitty north. But like on average, I'm assuming nationally it's still trending higher, you know?
Yeah. So I guess here's a key question though, to make this all relevant for a real estate investing show, is how does this affect your guys' thoughts on like a real estate investing business? Does this change any patterns? Does this change any way that you view, I don't know, your goals or kind of what you expect for your lead flow, your deal flow?
If you're asking me
No.
personally, I mean, no. I mean,
No.
and the thing is, like, and we'll touch on this in the third segment, but like real estate is so local, and it does like your margin of safety is the price that you buy it at, right?
Yep.
So if you're a good at negotiation, or you can get the house, it's a dilapidated shape, then you can make any deal in any market work. Just depends on the price you pay.
Yeah,
Absolutely.
I agree. Yeah, I don't get influenced by macroeconomic stuff, mostly because it takes like effort, like which Dylan puts in effort to like find like the real data, where my effort's like, oh, what's the headline? Fuck that. I don't want to read it because it's already click. You know what I mean? It's clickbait, right? It's just trash. And you can spin this graph like that you send us, Dylan, any way you want in a headline. So I just don't ever get bothered by that stuff. But also, to your point, Dylan, most of the people that get worried about what the actual market is doing are people that have no ability or skill set to buy off market at a discount. They don't know how to market to sellers. They don't know how to find the sellers. They don't know how to negotiate deals with the sellers. And like, to me, I'm like, I can buy a screaming deal, and I have bought screaming deals in low markets and high markets, you know, price wise. And so it doesn't really affect me much.
Yeah.
And if the trend is true for everything that we're saying, if you know, big if inflation is going to run rampant, then having your money in real estate is probably not a bad idea.
Right.
Totally. Yeah.
Exactly.
And having systems to find opportunity is never going to be less valuable because everyone's going to think the same thing. I mean, this is one of the big reasons that Dan and I have always leaned so heavily into like the wholesaling model, or honestly, like been happy sticking with residential real estate. Well, so many people are like, we're chasing these larger multifamilies and industrial and commercial other stuff. So I absolutely recognize the opportunity in that. But I can't tell you how many times Dan and I were at like these like GoBundance meetups or these other sort of like real estate meetups. And these guys were like, you guys do residential? It's like, well, I do 30 to 50 unit multifamilies. And then they talk about their deal. And I'm like, so if things go perfectly and the economy doesn't shit the bed, you're going to make like 200 grand in like 4 years.
Right.
It's like, we can make that in 2 months.
Yep.
Like just, you know, doing transactional real estate. And you're going to honestly tell me that what you do makes more sense. Like we're not bringing on investor debt, right? We're not going and risking your grandma's retirement. Sure, it's more active, I guess, throughout the process, but
I don't even think it's more active, dude.
It's definitely not for us now. When you're starting out, it probably feels that way.
Maybe. Yeah. I agree though. It's like, I really do think that most people have a really hard time actually figuring out what ROI means from a like return on actual cash invested and time invested. And they come up with these things that they think are super sexy. And they're like drug addicts. They're like chasing the dragon, chasing that next high, chasing that next, like, what is everybody else doing right now? And most of the time, by the time you find out about that, the dude who like pioneered that is already making the money. And now he's just like looking like it's easy. But it's like, dude, that guy's 5 years into it.
Exactly. They're all just driven by the fact they want to go on Instagram and be a white guy in their 30s that says, I own 400 doors, you know?
I own 1% of 400 doors.
Yeah, exactly. 1% of 400 doors. I cash flow $1,500 a month. It pays half of my rent.
I mean, that in the past, if you're following the trend, it might be already too late. And an anecdote to that is there's a guy that I know who's in GoBundance who made great W-2 income. So all he did was LP stuff. He was in 7 different LP positions, right? Like 50K a piece. One of them is currently paying.
Oh, really? Shit.
Yes.
That sucks.
One of them is
That's
paying.
brutal.
Dude. That is brutal.
I mean, yeah, that's
Speaking of which, I better go check my LP investment.
I think our one is probably good. He's communicating well.
No, he's good. They're it's a development thing. So
yeah, but I mean, and that's a valid point though, right? And if you want to make real money and you want to go by the model of our show, learn to make massive income, not just passive income, you have to focus on the business systems. And the great thing is, if you learn how to build out the marketing and the sales teams and kind of do general analysis, identify opportunity, kind of like Dan said, you can make money in any economy or any market, kind of regardless of what things are doing. It's like, sure, there are periods of time where you can make more money. Like we definitely made way more money in 2021 than we have over the past couple of years, but we did that because we were primed and ready to go. Yeah. And it just like,
and how many people left during that time? Like how many people that were doing it for 5 or 6 years are like, F this, I'm out.
In 2021?
Well, like
Everybody.
leading up to COVID, right? That's what I'm trying to get.
Oh, leading up to
Yeah,
COVID,
yeah.
a lot of people did.
Yeah.
Yeah.
Right.
Everybody did. Like our main competition, like that's when they were all like exiting, when we were like blowing up.
I literally remember hopping on a like Zoom call. It was like this, like the Spokane, one of the biggest guy in town. He put on the Zoom call, and it was like he a private invite thing that he sent out to all of the, I would say, active players in Spokane. So there was like 20 of us on here when we all had to sit in our houses in fear because you didn't know if you're going to walk outside and get killed by the trees or wherever we thought COVID came from at that point. And he was literally like, we are all getting out of the business. Like this is the end of it and all sort of stuff. And Dan and I are sitting over there and we're like, I feel like we should just do more of this. And sure enough, we did.
Kind of invested in this at this point.
Yeah. And I was like, I got some cost bias. I got nothing else.
Yeah.
You know, and sure enough, it took off because there was that gap that was there. But then going into 2021, right, everyone that was in the industry was making hand over fist money.
Yeah.
I mean,
what's funny is a lot of those guys are kind of like not coming back, but like they kind of have tried to come back and they can't even get close to coming back. They can't do anything.
They can't hang at all, dude.
It changed so fast. The industry changed so fast in like a few years.
Yeah. I mean, just like so much more technology has come into play, so much more sophistication, so much more money behind it.
More professional people, like guys like, I mean, honestly, like Dylan, like you're coming in, like you're not a dummy. You know what I mean? Like, you know exactly what you're doing.
Dude,
and
some of the OG players, they would write down their deals on a piece of paper, right? And they would just go through a Rolodex of people they knew. Like,
yep.
So,
exactly.
But I want to touch on something. Like, how many different markets are you guys in right now?
Like
14?
14? Did we start? I think we started 14 this month.
14
15 maybe, 15 maybe including our home market.
No,
what,
14 including our home market.
Do you know what your lowest and highest, like median home price would be in any of those markets? Like the lowest
the lowest price point, God, this area we're in Central Texas, dude. We're getting contracts for like $8,000. It's crazy.
Pretty brutal.
Yeah, there's a lot of homes that are in like the 60 to 80,000 range.
Yeah.
On the high end right now that we're getting
$1 million.
750. Yeah. We're not getting stuff up there like consistently though.
That's true.
I would honestly say on the high end for us is probably pushing Spokane, dude, at like 500,000 average.
Yeah.
Okay. So the reason I ask is because this data is straight from Redfin, and it's just a median sales price basically from 2013 up until 2024. And it's still up and to the right, pretty much, regardless of what market that you're in. With like LA County being a median price of $900K, and Philadelphia on here is being like $250K. And I say this as like an anecdote of all the different markets you guys are still pushing deals. And like my home market, we still have 2.5 months of inventory, which is like low for us. So like if you flip a house or it's a good deal, it's going to get sold pretty quickly. My buddy Drake, who's also in Scale in my GoPod accountability, he's in like a Central Texas market, and they have 9 months of inventory. Right. So doesn't stop him from doing deals, but it's just different in how you underwrite maybe the deal on the back end or doing a flip, right? You might be a little bit more conservative with your ARVs, et cetera.
Yeah. I mean, more conservative, account for more holding costs, right? Expect prices to shift throughout the period of time that you hold it. But I mean, that's a really valid point. Yeah. So we were at like 32 days on market for average when we looked at this, like, I don't know, a month or two ago. And like I have my old primary home that is in like kind of the A class area, top school district, right? Put it on the market for a price that I thought was too high and accepted, and like basically no contingencies offered, $20,000 over asking price in the first 24 hours.
Wow.
So, I mean, it happens everywhere. Or like also here we have a major affordability issue because a lot of people that live here just don't make a lot of money. And so the lower end stuff will sell super, super fast. What kind of gets tricky for people is like the higher price points in like the B class neighborhoods, you know, because people would rather like buy up to the A class or just stay more affordable. But
like I'm looking at the stats. You live in the third highest area in Spokane medium home price.
I believe that. I mean, like my people
you got room to go
for
up.
$1 million.
That's what I heard.
Yeah,
I do.
I was trying to fact check your stats here and see what you're saying. But like what I'm looking at is like first statement here is our MLS. I think is ran by dumb people. It's quite possible. Like their
Or like
ability
every
to
MLS.
their ability to like actually show data is so challenging, and like they're using such poor measures to do this. But yeah, I would say just my qualitative metrics on like data, like thought process on this data is I know flippers that are flipping and they're doing all right. They're pricing their properties different. My neighbors across the street are selling their house. They've already got people wanting to buy it. We had another neighbor up here selling their house. Like, so things are moving. It doesn't feel like a frenzy, which is actually kind of nice, but things do seem to move. And I would say that there's probably a higher number of houses that fall out of contract, and it maybe takes two buyers to get it closed, though. You'll see that quite often.
Right. I think from my perspective, I'm doing underwriting on a deal. Now it is more important to see what is listed and currently pending versus what sold 6 months ago. Right. Because I think that might get you in trouble. Right.
Yeah. That's been a big change we've made to our underwriting too, is looking at what's pending and trying to like see how long it's been on market for, to sort of hypothesize if it's going for list price or it's going below.
Let me ask you this, Dylan. Would you like you're marketing to everywhere in Cincinnati that you want to buy stuff? If you come across kind of like a weird one, what do you do with it? Like you're like, oh, this is a decent deal on paper, but it's weird. Like it doesn't have a living room or some shit. You know what I mean? Like, it's got a weird layout. What do you do? How are you pricing that? Or are you just walking?
So lately I've been done more actually flipping than wholesaling. And we can touch on that because I used to also wholesale to buy and hold people, but with rates at 7.5%, it's basically only exclusively flippers lately. But I would look at it. Can I take it down, change the layout, right, and make it work? Other than that, I would try to just do some solid negotiation skills, get it at a price that makes sense, and go to my go-to buyers and see what I can do. I personally probably wouldn't want to take it down if it has too much stuff going on to it.
Right. Sell it to some flipper that's going to flip it and do their thing that maybe has better systems. Like, Mike and I have found like we don't want to buy things on busy roads. We don't want to buy things with quirky little weird layouts, like things that, because buyers have options right now. So they're going to be like, oh yeah, you did a great job in the rehab, but my kid's going to get hit by the car in the 45 mile an hour, speed zone right next to it. Stuff like that. Like, or that just has like these weird, they're everywhere. There's these weird, funky layouts or weird, funky locations that, just weird lots, all that stuff.
Right now that would consider high end for Cincinnati. And this will be in my hard lessons on the Slack channel that we got in the scale community. But I've literally, if we close on the expected date, which is later this month, I will have owned it for 356 days.
Brutal.
And the reason is that it's a great remodel. All the feedback I get is love the house, price accordingly, great school, 4-bed, 3.5 bath with a pool on an acre. All that's great. It's right next to a goddamn highway. So the highway noise deters everybody at that price point.
Yeah. But you know what, in 21, or even probably when you bought this thing, that might not have mattered to people, but now it definitely matters.
Well, I didn't think it mattered because someone lived there before, but
totally.
That's true.
Yeah. Stuff like that always gets tricky. But either way, I think point being with all this is, don't focus on like the little economic details. I think it's important to be informed, right? And to kind of understand what's going on. And you can use that to, I would say, like pitch things to buyers, or like understand your own opportunities, especially if you're, for example, sitting in your own home with a bunch of equity. If you're going to be able to get a little bit of a easier, cheaper HELOC that you can use to do some flips or some loans or whatever you want to do, understand that. But really, if you learn to market and, run a sales team and, analyze opportunities, you can make money pretty much anywhere that you want to. Just balancing expectations, right? Because that's the other thing too, is so many people, they want their business in Central Texas to look exactly the same as a business in the Northeast. And that's just not how it works. That's where the difference in economies.
You live in the Bay Area, so it's harder to, flip there, which we can have that discussion, but just don't be the guy that's on citydata.gov or whatever for 10 hours trying to figure out what the best market to invest in. Use some of that data and then pick it and go for it. Like,
absolutely. Just pick anywhere. And I can tell you from experience, being in our 14 markets, you can find leads literally anywhere doing the exact same things. It just comes down to expectations over how many leads you're going to get and how complex the conversations are going to be. Because here's the other thing too: if you're in a more expensive market, people are going to understand that. It's not like you just find dummies in San Francisco who are like, I bought it for $300 in 1995. I think $350 sounds pretty good. Like they're all fully aware, even if they're, a little bit more of a interesting person. Like the thing that always gets me in Idaho, we'll have these people that didn't graduate middle school, dude, and they will know down to like the cost per
here.
down to the cost per square footage what their property is worth. It's crazy. They got no teeth. They are cued in to the value.
Fuck are
of their
these
deals,
people?
What are you talking about? Don't you remember like the junkyards and shit that we used to get? Like the leads?
Yeah, you're right. I was traumatized.
Dude, it's crazy.
I think the point to make here, if I could, is like I've seen people crush like real estate in a town of 3,000 people, and I've seen people crush it in a city like Chicago. And your business model needs to adapt to that, and the way you do it. Like a guy in 3,000 people, he just goes around and tells everybody he's buying rental properties, and the next one time their grandma dies, like he goes and buys it, rents it out, rehabs it, rents it out. The guy in Chicago has to figure out exactly what he needs to do in this market, in this competitive big city market, to actually get deal flow. I mean, you just have to adjust. You just can't go listen to what the guru on the internet says that worked for him 5 years ago.
Yeah.
Right. Yeah. That's props to you guys too in the scale community. I think, you guys have adapted as the market has needed, the past couple of years. So that's what I like about your group too, is like, it's not just repeat the same shit over and over and over again and be like, oh, you're just not doing it right. No, like, let's try something else.
Yeah, I appreciate that. It's the value of being an operator guru, not just a guru like so.
Yeah, we're both operator gurus.
Yeah. Right.
You know what? I love that tagline, actually. I'm not just a guru. I'm an operator guru.
Yeah, right. You could make that your thing. Yeah. But cool. Awesome. Well, we're at about time here. Dylan, I appreciate you hopping on for this first one.
This is fun, man.
Definitely a different take. I enjoyed that conversation. We'll see if other people like it too. And I'll ask our producers. And if they're like, you guys sound like squares now, then we'll figure it out at that point.
All right. Well, regardless, thanks for the opportunity. May or may not be back.
Yeah. So either way, Dylan, what are your socials though? If people want to follow you.
Yeah, just type my name into any Facebook, Instagram, any of them, which is just Dylan, Dylin. Last name is Koch, spelled Koch, and I'll pop right up.
Yep, it's Cook, not Cock. Remember that, everybody. Very important.
Wow, I would have said.
Guess who got it wrong? Yeah,
yeah. Guess how Mike learned that.
All right, guys. Well, thanks for listening, everybody. We'll talk to you guys next week.
See you.